Today, we want to go through the sort of the group's position, including the sort of half-year results, the interim results, but also looking much more into the future position and some of the growth opportunities that we have in the organisation, both from our previous Capital Markets Day and, as mentioned, with the recent acquisition as well. Obviously, 2022 has been extremely challenging. I think all of us have experienced many of the macroeconomic and geopolitical issues through the course of the year. However, I think during the first half of the year and beyond that, we still have delivered a very strong performance in many respects across the three categories, and made very good progress towards the targets for 2025 that we originally set out in that Capital Markets Day back in late 2020. Our strategy to achieve the £67 million gross profit by the end of 2025 still very much stands through organic growth. And any acquisitions really just accelerate our growth trajectory, which we'll show as we go through this presentation. Group's revenues of 50.7 million at the half year were impacted obviously by the ongoing conflicts in the Ukraine, with the group's adjusted gross profit margin showing an uplift of 1% during that period, driven by some very careful cost management of costs through the business. Despite the backdrop that we've had, very good, strong progress has been made to deliver on our commitments to double revenues, particularly within the water and the appliance categories. Well, I think we're really starting to experience some really positive traction with numerous awards for our appliances and some quite material contracts being secured within both the water and the appliance categories during that period. And so we will definitely see some significant uplifts in the second half of the year that Harry will talk about shortly and beyond. And these are projected to deliver double-digit growth for both categories as we move into the second half of 2022. As always in Strix, we have maintained a very, very strong focus on our cost control within the core business, particularly given the current environment. And we've taken actions to manage those variable costs in China and our production line in particular, as well as to implement further price increases to offset the various inflationary and commodity cost increases that exist. And certainly when you sort of look at the margins, they are strong for the first half of the year. And we're very confident now with those price increases and some improvements in commodities, we'll start to see a slightly better buffer as we move into the second half of the year. Global cattle markets have definitely experienced some softening due to that conflict in Ukraine, as well as the recessionary fears in the regulated markets. However, we have managed to maintain our share through that period, despite those headwinds, and we remain very confident, as in previous times of recession or any disruptions in the marketplace, that this will rebound and return to the normal levels on exit from the recession. Really, it's a question of timing. We're also making great progress with the ESG commitments that we have put out. We've published an interim update on our new website during the roadshow. We remain on track to be net zero by the end of this year and are working very hard now on our Scope 3 commitments. Worth bearing in mind when you read that report that we were running 2 factories for a period during that time as we moved into our new facility. But going forward, we'll get the full benefit of that investment. So you'll see some quite significant improvements in our KPIs when we report in the middle of next year. Based on the performance of the business, cash flow and so on, as a board, we have maintained our interim dividend at 2.75 pence, which I think does demonstrate our continued confidence in our commitments for the midterm targets. I mentioned the website, that has been put up. We've had a lot of new material put onto the website. So again, I would encourage you to go and have a look if you haven't had a chance to see that as yet. Harry, can we move to the next slide? So just a quick look at numbers. I won't bore you. These are obviously quite old now, being sort of the first half of the year. But we saw a revenue drop of around 7.3% during the same period last year. But it was 15% up during the same period in 2019, if you're looking at a pre-COVID comparison. Those revenues, as I've mentioned before, negatively impacted by the conflict in the Ukraine, the peripheral geographies, and that fear of recession in the West. From an adjusted PAT point of view, that was down 5.7%, driven by softer sales and higher interest rate costs, but it was also offset by some very good reduced tax expenses, where we've actually managed to negotiate some quite attractive deals with the local government, particularly in China. Another change was a change in our accounting policies, which some of you may have picked up in our RNS more recently, and that was relating to the useful lives of assets. And that was flagged as a concern during our year-end audit. So we had to take action of that during the course of this year. Net debt itself closed at 61.3 million, driven by higher working capital, partly driven because of COVID and the issues we had in China in securing a second site, just to make sure we were protected against any lockdowns, but also earn-out payments to the Leica owners following that successful acquisition of Leica. And this is just a quick look at the margins. I mean, we put a price increase in July of 2021, and we put another price increase in May of 2022. I think you can see the first price increase was already starting to protect those margins. So Kettle Controls was actually up by 0.7%, and overall as a business, we were at 1%. With the second price increase going in May of this year, the half year result actually only shows 1 month impact because there's always a bit of pull forward when we do that. We are building up a nice buffer for the second half of the year, so very confident on the margins for the Kettle Controls and overall for the business going forward. And that's still very much in line with our 5-year plan that we put out in the Capital Markets Day. So with that, I think I will pass over to Harry, who will cover the 3 categories in a little bit more detail, and then I'll come back and go through the acquisition that's been recently made.
Thank you very much, Mark. Good morning, everyone. I'll start with the kettle control category. I think, as Mark has mentioned, it has been a very challenging first half of the year. So the overall market for kettles has shown a decline of circa 15% in the first half. The less regulated market has been impacted by the conflicts in Ukraine, again, as Mark mentioned, while the regulated markets have seen some softening caused by recessionary fears and the cost of living crisis. In addition, the China domestic market has been impacted by half one due to extended lockdowns, which I'm sure you're aware of. Overall, that has seen Strix have an impact of 11.7%, as you can see from the slide, as a result. But we have maintained our 56% market share despite these headwinds, and we remain well positioned for the future. Typically, at this time of the year, we enter the peak season, and in fact, we're really in the middle of it now for kettles. And that's driven by various online promotions, Christmas and the New Year promotions. China is always the first that we see in terms of recovery and in the China domestic market. And we actually have seen that be very strong in the second half following the lockdowns that they had in the first half. In the export market, we've seen some uplift, although we are still to see a full seasonal uplift at this stage. And just to give you some context around that, we work very closely with our OEMs and our factories in China. And in the first half, the capacity was operating around 50%. We've seen that increase to around 80 to 85% at this current moment. Normally at this time of the year, it would be closer to the 100. So it just gives you some feeling of where we are. But we are now pushing towards that 85% capacity in the factories in China making kettles. From a development side, we continue to work on a new range of controls that will reduce costs, improve specifications, and further challenge our competition. We're also developing a number of new features to increase the focus on reducing energy consumption for consumers. On this slide, we're trying to give you a little bit of an understanding of how the kettle control market and Strix in particular performs when we have a recession impact. The kettle market has consistently shown growth over the last 2 decades with a CAGR of circa 5% in volume. During this period, we've experienced many challenges, including COVID and various recessions. As a tier 4 supplier in all of these cases, we experienced an early and initial slowdown in our volumes as our discretionary element of purchasing is held back. But the distressed purchasing, i.e. replacements, is maintained, typically limiting the shortfalls to circa 15 to 20%. We've now seen this impact, and typically this lasts, from our experience, and as you can see from this graph, between 1 to 4 quarters. But as we begin to exit such periods, we really experience an equally fast recovery that returns the market back to the same growth trajectory, recovering any lost ground. As I mentioned, the dip is normally between 1 to 4 quarters. We're around the second quarter now of this latest challenge. The question, of course, is when will it end? And of course, we don't have that answer, but we have the confidence, as you can see from this graph, that when the bullwhip effect happens, as we call it, we're confident that the market will recover and will not impact our midterm growth targets for this segment. And history has shown that at Strix, we often see a very strong exit, as I mentioned earlier, from these recessionary periods. In terms of the second category I want to move to is the water category. The water category has seen some positive traction during half one, which has formed an excellent baseline for the remainder of the year, and despite the changing environment. I think it's also important to note that although the growth has maybe not been to the level that we wanted it, and at only 3%, This is on the backdrop of declining markets of, again, circa that 15%. So we are able to overperform the market and really continue on our growth plans, even if not quite at the levels that we wanted them to be at. We have seen the new products being successfully developed and distributed from our new factory in China. If you remember from previous presentations, we were in the process of moving all of our manufacture for water products from the third parties to all in-house, and that's now all in place. And in the second half of the year, we're really going to see the expansion of that and the benefits of that. An example of one of our new product ranges that we'll be launching from our own factory is the Perfect Pour range of jugs, and we'll show you those on the next slide. Something that we're really excited about. One of the challenges we often face is that there isn't a lot of difference between us and the market leaders on water filtration and water jugs, and that's common across the whole competitive landscape. However, with Perfect Pour, we really feel that we're bringing something new to the market, innovative, and really gives us an advantage over our competition, including the leaders. We've eliminated the issues surrounding Brexit, using our facility in Italy as our European base, and that has enabled us to really expand our European business for both of our Aquoptima and Leica brands. Finally, we're also gaining traction in distribution with positive growth in both Europe and the USA, with some strong contracts now in place in the second half of this year, and really giving us the confidence for 2023 and beyond to achieve our midterm targets. As I mentioned, we've experienced a 3% growth within the category in the first half of the year. But as we exit the first half, with the new contracts in place and the new geographical expansion, we really see starting to hit those double-digit growths year on year, and we're really confident that that will continue for the rest of this year and into next year. We continue to focus on the geographical expansion that I just mentioned, and you'll now see that we are cross-selling Aquoptima and Leica in various territories, including the UK, with a further expansion of our digital platform driving growth in half two. Online has been a strong area for us in terms of growth, and we're really expanding with new marketplaces. But we're also getting now some really strong in-store and traditional distribution, and that's really giving us the base to expand and grow moving forward. Leica is now fully integrated within the group, and our Italian base has now become the centre of excellence for this category, the water category. And we now have our sales team across Europe covering both brands and also expanding globally the portfolio that we have. The final category is appliances, but just before I did mention, I wanted to show you a little bit about our Perfect Pour. You can see here our new branded packaging, but you can also see some of the lifestyle shots and the new type of design and Perfect Pour, which is of course in the name, that we will be introducing to the market in the next month or so. So look out for that. We're really excited about this product, and we've got some really great response from our customers already on this product. Finally, on appliances, the appliance category continues to be very exciting for us, and we are getting some really positive traction. The Aurora range, which I'll show you a video of shortly, has really been well received and is exceeding our expectations in terms of both volumes and market feedback. We've received several awards. One of those awards is the Sustainable Product of the Year for 2022 from the Housewares magazine. We've also been nominated as the SDA Product of the Year from the ERT group, and we're really confident of continuing on delivering those recognition and awards in the market for the Aurora family of products. We've expanded the routes to market for our appliance products, and this range is now selling across UK, Western Europe and North America, across digital platforms, but also now starting to gain traction within the traditional bricks and clicks market as well. So again, really giving us confidence that we're driving towards our midterm plans. In addition, we've seen the successful launch of the Dual Flow and the Visione induction kettle. So these are two products that really give a sustainable message, really enable the consumer to only use the energy that they need, and really helping us demonstrate that innovative approach towards more sustainable products. Both those products have been launched within the UK and now expanding through Europe. You may have also noticed that the baby sterilizer dryer that we have been talking about over the last year or so has now been launched in the USA under the Baby Brezza brand. That's had tremendous consumer feedback, and we're now looking to expand that together with Baby Brezza into more markets around the world. So again, a very positive launch on the appliances area. Again, similar to the water, whilst we deliver 7% growth in half one, which is not what we wanted it to be, but if on the backdrop of a market that has declined between 15 and 18% in the SDA space, small domestic appliances, again, we're really confident that that's a strong performance, outperforming our competitors, outperforming the market, and really giving us that confidence to progress in the second half and into 2023 and beyond. Again, like I mentioned on the water, we're really now showing that traction to double-digit growth year on year, and we're really confident that that will continue for the rest of the second half and also give us a strong base into 2023. So I just want to show you one final slide and a short video on the Aurora, and hopefully you'll, if you haven't got one at home, you'll rush out to get one soon.
We know there is a time for comfort. We know the refreshing feeling of a chilled drink. And we all know the benefits of filtration. But what if you could reclaim your kitchen and do all of this simply and beautifully? Hot, boiled, chilled, always filtered. That's the Aurora. With the Aurora, your whole family can enjoy the benefits of healthier water whilst reducing your impact on the environment. Aurora by Aqua Optima is packed full of our simple-to-use features to give you the confidence and taste you want. Built around the concept of giving you control. Control of temperature, from chilled to boiled, and everything in between. From a glass to a pan, you choose what you need. The Aurora features the Fast Flow Evolve Plus 5-step filtration system, removing tap water impurities while maintaining our unmatched fast flow rate, delivering great tasting water. Our unique compact design saves space, time, and energy, so you can enjoy the perfect drink every time. So take back your kitchen and take control of your water. Introducing the Aurora. Your drinks, your way.
I think, hopefully what you've heard from Harry, we have built some very, very strong foundations over the last 6 months. You're really starting to see some double-digit growth out of the exit rates coming out of the first half of the year for both the water and appliances. I just want to reiterate that we came out in 2020 with our plan to double the size of this business, 200 million pounds worth of revenue and 67 million pounds worth of gross profit. That's still very much our plans. We have business plans to be able to achieve that. And anything we do outside of that, such as acquisitions, as we've always said, will be accelerating those plans. And hopefully, as we go into this next section where I talk about the conditional acquisition of Billi, you'll sort of see how that impacts the business as well. But it certainly will significantly accelerate where we're going forward in the business. So if I can just go to the first slide in there, Harry, thank you, just for the executive summary. Just a little bit of background, first of all, on Billi. I mean, it's a business that we've been looking at now for almost 6 months, since we really first started talking to them. It really does fit our vision and strategy perfectly. It's an innovative product. It's a premium product, strong focus on quality, and it's very, very strong on the customer service side as well. I have been looking for the last 18 months for strategic acquisitions, found it very hard to find something of suitable scale in the business and that is such a strategic fit. I'm sure as we go through this part of the presentation, you'll realize just how perfect this acquisition has become, albeit the timing probably is the worst possible timing for any acquisition in a business. And we'll talk about that too. Effectively, it's become available because of a wider deal, a merger between Culligan and WaterLogic. Culligan owns the product called Zip taps, many of you will be aware of, and WaterLogic owned Billi. And the Australian and New Zealand competition authorities said that they would have to divest one of those businesses before they could do the wider merger. And they chose to divest Billi. It was a more premium product, but obviously the smaller of the two businesses. Probably worth noting that the Zip and InSinkErator, two similar type products, both sold in the last 5 years, one at 20 times EBITDA and one at 17 times EBITDA. So this particular market segment is extremely attractive. And you'll see sort of how we got to the deal we got to as we go through. Because of the different segments of this business, all of the competitive authorities are working together. So we will have Australia, New Zealand and UK, which is effectively the whole. We managed to actually secure this business at an attractive multiple of 3.8 times EBITDA. And that gives us a very positive accretion in year one, mid-single digits, and a double-digit accretion as we move into 2024, even with the current sort of economics that are out there today. I mean, it's worth noting, and I won't labor this point on the call today, but this has been a very, very difficult journey for us in terms of trying to acquire this acquisition. We started 6 months ago. We were looking at an EBITDA times of about 11.5 times. There's a lot of people in the discussions. We obviously got into an exclusivity period over a period of time. And actually then the CMA actually claimed that there were some issues as well. And therefore they had to divest that Billi UK. That changed the profile of the business. And again, we had to go back into negotiations. And then we had all of the mini budgets, equity raises, all of which caused us tremendous problems given the current sort of macroeconomics. I'm really pleased to say, with the support from Autologic as well, we did manage to close the deal in the beginning of October, and that was at that 3.8 times EBITDA. So a really, really positive deal for the company, and you'll see some of those margins going through as we get further into the presentation. As part of the process, we did raise some equity, 13 million pounds we raised. Actually, we did raise a significant amount more than that. Anybody who was involved in that process will have seen that by the way it was scaled down. We only actually needed to raise 10 million for the banks, and the extra 3 million was for fees, which is part of the conditions of the bank loans as well. So that worked out very well for us as well. And if you look at the debt, one of the concerns we had when we first started this, particularly with all the SONIA rates changing during the process, we will start the process with a debt of 1.9 times. And by the end of 2023, without any synergies, and we've already identified some significant synergies in this business, you would be down to 1.4 times, which is below where we are today for our core business anyway. So both businesses are very cash generative and will allow us to pay that debt down extremely quickly. So if I move into the next slide, please, Harry. So this is just sort of looking at a quick overview of the business itself. I mean, you can sort of see on the right-hand side of the graph there, you can see Billi and Zip together. They are the number 1 and 2 players. And when you look at Australia, New Zealand, and the UK, quite different products. In fact, I would consider Billi to be the premium product. It's a water-cooled device. So these are, as you'll be familiar with, I'm sure, that you have an item under your sink and you have the tap on the top. And effectively, in this case, for the Billi, it's almost like a little mini fridge you have under your sink. So it's a self-contained unit. It doesn't need lots of ventilation because it's self-cooled, and it's a very efficient system in the way it runs. And the refresh rates for the boiling water is also very high as well. In terms of management team, we are bringing over the core management team from the business. So Carl and Rachel are based over in Australia. He's the CEO and Rachel is the CFO. So they're both very, very keen to move over to the business. And in the UK, we will be bringing in 42 people. And we've got a management team being brought over from the UK as well. Many of those people were from the original Billi UK, which existed about 5 years ago. So very experienced. And from day one, they will be able to run that business. We do have a TSA in place for a period of up to a maximum of 1 year. Clearly, we intend to move out of that as quickly as we possibly can, but that obviously gives us some protection during that transition period as well. Also, from an ESG point of view, it fits extremely well for us. It's eliminating the use of plastic bottles. It's highly energy efficient. It's got many awards, as you can see from the screens there already. So it does fit with our sort of targets for net zero and scope 3 in particular going forward as well. So for us, a really perfect fit to the business. And if I go to the next slide, Harry, please. This is just sort of looking at some of the strategic rationale, and I will go through these in a little bit of detail, just because the importance of that sort of strategic position. So first of all, it fits almost perfectly with our 5-year plan that we set out in 2020, growing the appliance and the water segments of our business. Earnings, very, very good in the first half of the year. We're going to be mid digits in the first year, which is next year. And then we'll be into double digits accretion in 2024. So giving a very positive return to investors. Mentioned the ESG, very, very positive. The culture is very, very similar to Strix, not just for ESG actually, but for all parts of the business. And certainly they are doing all the right things to make sure that they can achieve the appropriate ESG accreditations, and that will strengthen that position going forward. As with Strix, Billi is recognised as the premium product in the marketplace. Very, very close attention to safety and quality, which again fits with our own strategy. Is providing a reduction in energy consumption, a reduction in single-use plastics, provide safe drinking water. So again, linked very similarly to the strategies that we've had with Leica and Aqua Optima as well. One of the things that's quite interesting for us as well, we are a company that I think is quite renowned now for our innovation and the patented technology that we're able to hold. We do believe there's quite a lot of opportunities to use some of our existing technologies, and I'll touch on the slide a bit later on, to enhance some of the products as well within the Billi range. And certainly over the next 18 months and beyond, we'll start seeing some of our technologies being integrated into their products as well. The market itself is a very strong growth market, very, very significant potential to expand into further areas, so moving more into residential environment, for instance, but also moving into new geographies where we've got very good positions, for instance, in Italy, China, Hong Kong, Taiwan. We have our own offices in all of those locations. And they're areas where they only sell a very small amount of product today through distribution. So clearly an opportunity which is not baked into our numbers at the moment going forward. And I think, from a synergy point of view, we've already identified something like £1.5 million worth of synergies that are available, whether that be in procurement, whether it be in innovations and product designs. But certainly within the next 12 months, we'll be able to get those £1.5 million worth of synergies in place, which obviously will improve the performance and the debt ratios as well as we go forward. If I can move on to the next slide, please, Harry. I think this is a really good illustration of how this changes our profile. You can sort of see on the revenue graph, we had a target of 199 million. Clearly, Billi is going to change that quite significantly. And from a gross profit point of view, we had our target of the 67 million. Actually, if you look at a sort of pro forma basis in 22, we're almost there. So in 2023, we will hit our 5-year target plan in terms of both, certainly in terms of profit and getting closer on the revenue side. What is likely to happen towards the middle or towards the end of 2023, we will actually relook at our next 3-year plans and come out with an updated sort of strategic plan or business plan. And that will then show you that incremental part of Billi coming into our system as well. So as I said at the beginning, we have not changed our strategy. We are still driving organic growth in the business. This was just a really positive acquisition, albeit at a difficult time. It is, we believe, as a board, that it's absolutely the right strategic addition to the business, and the long-term impact will be extremely positive for investors as well, as you can see from the charts here. And if I can move on there, please, Harry. And this is really just sort of showing how the business splits. So when we came out in the Capital Markets Day, we said that by 2025, the Kettle part of the business would have been half or 50% of the business, still growing at that sort of 3-4%, which it has been for the last 2 decades. And then the other 2 parts, the water and appliances, would make up the rest. Again, this is just accelerating that position. From next year, we will already be in that position where 50% of the business is actually the Kettle business. As I say, still growing and still maintaining the profitability that we have in that core business, but allowing us to expand significantly and diversifying as well. Worth noting also that the manufacture for the Billi products is over in Australia. They've got their own manufacturing site, which I went to see over in the due diligence process. So again, it diversifies our footprint as well in terms of manufacturing capabilities around the world. And again, Harry, thank you. An important slide, particularly in the current environment. One of the questions we got asked an awful lot about during the roadshows when we were sort of talking to investors about raising equity. And it was a very challenging time in the first instance because we were looking to raise something like £30 million in the first scenario. We then had the mini budget and we had to change our plans. So we actually reduced the amount of equity raised, which is obviously beneficial in the long term. But you can see from that deleveraging chart just how quickly we delever the debt side of the business. And as I said before, that's without any of the synergies baked in. As a board, we have tried to take a very, very pessimistic view. So we've got very, very low growth rates, which are actually below the market growth. We've taken out all of the synergies to make sure that we are confident that we can continue to pay dividends appropriately and that we can achieve these reductions in debt. And we haven't taken in any of the significant geographical expansions in the business either. So maybe not the worst case scenario, but I think pretty close to being the worst case scenario. From a dividend point of view, we are changing the dividend policy slightly. We're still keeping a progressive dividend, but we're making it a 2% year on year going forward, rather than being linked to underlying earnings, because that jump to underlying earnings would just be too higher amount in the dividend. Bear in mind that today we're sitting at a yield of about 8%, so very attractive from that point of view already. But yeah, as a board, still very, very committed, strongly committed to a progressive dividend. This is a discussion we have regularly at board level. And the next slide, please, Aaron. This slide was really just trying to show how this fits in with Strix. So yeah, we're well known obviously for the kettles. We've come up with lots of innovations. Apologise for the noise in the background there, not much I can do, I'm afraid. We've got the first induction kettle in the marketplace. We brought out electronic kettles. We've got the only dual flow kettle in the market that I'm aware of. We've then got the Aurora that you saw the video of, really well received, giving you all the functionality of the hot taps, but countertop. We're going to expand that going forward into what's called the Ontario range, that will give you all you've got with Aurora, but also give you things like sparkling, coffee, and other options as well. So just expanding that even further. And then you've got the next level of under the sink capabilities with Billi. And you can see that price range changes quite significantly between the £300 for a countertop version to lowest cost £1,500 for an installed system. With our technology, particularly the instant boil systems that we have in the Ontario and Aurora, we believe there's definitely a product that we can put somewhere between that Ontario and Billi to be able to further compete in that residential segment as well. So yeah, that's a watch this space without doubt. But given the success of the Aurora, we're very confident we can have a very strong pipeline of products. You're right from the basic countertop through to the industrial sectors that are being sold with Billi today. Just a quick look at the outlook. If we move on to the next one as well, Harry, thank you. And this is really just a comment from the RNS. We had put out a different PAT number, as many of you will be aware. There was a couple of reasons for doing that. One, there was a level of uncertainty, particularly in the kettle market. That really is what's driving that change, because of those recessionary fears that are in the marketplace. Harry went through that there will always be a rebound, and it always recovers or over recovers. It's more a question of when. So we're very confident in our 5-year plan that we'll get those numbers back. However, at the beginning of September, when we came out with the RNS, we didn't have visibility of where that would be. Because we were looking at the acquisition as well, we felt it's only right to come to the market with a range of sort of outcomes, depending on where we got to for the second half of the year. That range, is still stands today. We're still watching the market coming through. We have seen an uplift in the second half. It's still not where I would like it to be for the full year, but certainly we've seen quite a significant improvement over the last 3 weeks since the October holiday in China. It's been a very strong improvement, and we continue to monitor that. Within the next 2 weeks, we'll have a much firmer view of the full year. And if we feel that there's still risk in those numbers, then we'll be looking to take further cost out in our China factory, in particular through the variable costs, reducing overtime and putting production on the automated lines, stopping the manual lines, as we did in COVID, which actually has a positive impact on the margins as well. So very much watching the current situation. Black Friday will be an interesting day to see how much product is sold in the current environment. Obviously, there's been lots of changes in the UK, in particular with the government. So it'll be interesting to see how that changes people's views on spending as well going forward. But yeah, we are very, very confident in our 5-year plan. Obviously with Billi, assuming everything goes ahead with the Billi acquisition, and we're very confident that will accelerate us by about 2 years. Probably just worth mentioning the conditionality of Billi is on two items in particular. One is the merger of the Culligan and Water Logic, which is very imminent and was dependent on approvals from the CMA in the UK. And the other is approvals from the competitive authorities in the UK, Australia and New Zealand, all of which are progressing really well. So yeah, we are hoping to be able to close this certainly within the next month or so. Things are progressing very fast, and in fact, that's where I am today. I'm sat here in the university. So with that, if I may, I will finish the formal presentation and open up to questions. the Billi, there is definitely some cross sales capability between Billi and Strix. Actually, most of that is going from Strix to Billi. So if you imagine the offices in London, for instance, a lot of renovations going on. When we go around investors, they've all got a Zip or a Billi tap, or the majority of them have. But actually, they've also got lots of showrooms with bottles of water in every room. And there's no reason at all why you can't sell the Aurora countertop systems into those showrooms. And they could be quite high volumes as well. So we will definitely be looking to sell more of the Strix products, the Auroras, some of the Leica products and Aqua Optima into those customer sites when we're on site. Today, we're not visiting sites, we're not getting into customers' homes. This new business will allow us to get into the homes and into small businesses in a much greater way, and does expand the opportunities that we have available. Again, none of those numbers are built into our plans as it stands today. They'll be part of the sort of the strategic plans going forward. They do require servicing. That's why we have a team of 42 people in the UK, over 220 in total in the business itself, and they are high consumables. I mean, the margins of the business you can sort of see are very, very strong, and a lot of about 30% of that comes from the after sales service market. Also worth noting, in the UK, there's quite a strong rental market as well, which is really an extended service contract period. So people will actually buy a 5-year contract. And that really is the ongoing servicing that takes place through that period of time. So there's a very, very strong ongoing revenue stream, which is obviously very attractive as well. Very minimal. I mean, in Australia and New Zealand, a lot of work has already been done to separate the two businesses, and they run as a standalone business. We're keeping the main head office there and the warehouses. There's a couple of things that we would do to move out of some of the smaller warehouses, but actually that would be a cost saving for us over the short to medium term. And as I say, there's a TSA in place in Australia for more than 6 months to cover that period, so we can do that. But we're already actually working on that. The UK is a little bit further behind because that was a later decision, driven in part obviously by the CMA. One of the reasons I'm here today is we're looking at sites which are literally across the road from where they currently operate. They're all baked into the numbers that we've got into the system, but we will be looking to downsize a lot of the warehousing facilities because we just don't need the space that WaterLogic needed for those particular areas. So again, if anything, that will be an improvement over the next 12 months. From memory, and I'm just looking, I think it's just below 30% EBITDA margin on the Billi as it stands today. So slightly below the Kettles, but significantly better than the water and appliances groups that we have. We're not planning to change the distribution significantly. They have a really strong distribution group, and they've got a very good sales pipeline for the next sort of 12 to 18 months as well in the system. We're working with surveyors, architects, contractors. We probably will look to add some as we go further forward and reduce price or put additional products in there. So we may be looking at maybe some more of the DIY type opportunities. But that's going to be 18 months to 2 years down the road, not in the short to medium term. I mean, in terms of the profits and so on, I mean, that's something that we will come out later this year with in a lot more detail. We're obviously going through a budget process with Billi now and incorporating it into our own business with more realistic numbers than the ones we had during the acquisitions, which were highly sanitized. So I'm afraid it's going to be a bit of watch this space, but certainly when the acquisition is formally announced, in other words, when those conditions have been met, we will come out with much stronger guidance in terms of profit margins and cash flow. But it's extremely profitable and very, very strong cash flow for that business. I mean, very, very little. I mean, all of the costs have been calculated in the numbers that we've sort of put out, and there's assumptions for debt and so on. So we don't expect any additional cost. If anything, I think there is upsides in those synergies, as I've mentioned, going forward. both in the UK and in Australia. And I went and spoke to many of the customers and surveyors and had very positive feedback from them. So we did do the same sort of research, and we did see that a lot of it is actually very old feedback when you really do dig down deep into it. There was also quite a lot of issues in COVID because they weren't physically allowed to go on sites in Australia for a very long period. In fact, Melbourne, I believe, was the most locked down city during COVID. So there was quite a significant backlog they had to actually recover from after the COVID, which has now been done. They're down to a 3-day service level in Australia now, and they were up to about 12 days, I believe, at one point. So yeah, I think that it was driven partly by the market, but I'm very confident that the product itself is a very high quality, and certainly the more recent customer reviews we're getting are very positive. The term, so it's a 3+2 effectively. We basically have extended our existing facility and put a bolt on for the acquisition. I said there's a ratchet on the rate, which is linked to the SONIA rate. The only other condition that's been added was on the dividend payment, that we couldn't pay a dividend without approval if the debt went above 2.5 times. Clearly, we have no intention at all of getting anywhere close to that from the numbers we've got out there. By the time the next dividend paid is going to be June of next year, we should be down in the sort of the 1.6, 1.5, 1.6 times EBITDA, so well out of any of those covenants. A lot of headroom on all the covenants as well. Look at the hot tap market. We've been tracking Billi for 5 to 6 months. So the first accounts I saw were in February. They've got a 22% growth 2022. And they're on target to achieve that growth. So performed really well despite all those macroeconomics around the world. So I do think it's a business that is growing very well. If you look at the market growth, they're normally talking somewhere around 12%. We took a lower percentage in our own assumptions in our model. But I would be really disappointed if we didn't see at least a 15% growth year on year in Billi for the foreseeable future. Certainly my plans will be targeting that type of growth, particularly with the geographical expansion coming in as well. So I think, as I said, we always had said that we were focusing on the organic growth to double the size of the business. That has not changed at all. But I also said we would look for strategic acquisitions that would accelerate the plan, which we've done. I don't foresee anything in the sort of short to medium term on the acquisition front. This has got some really significant upside opportunities, which we really want to deliver on. So for the foreseeable future, I think the business is very much focused on the water and appliance categories that we had before, and expanding the opportunities within Billi as well. So yes, we will be looking much more organically going forward, certainly for the short to medium term. And actually, our debt financing actually restricts us from doing an acquisition for, I think it's a period of 1 year in that process as well. But I'm quite happy with that. From a debt point of view in the equity raise, I mean, I would have loved to have made this acquisition 5 months ago. If I did, it wouldn't have been at the price we made it. So I guess there's a counter there. We had the opportunity to raise more equity, and we did get very strong support at the reduced price. However, getting equity at the share price we're at today is not the optimum time to do it. And the conditions we had around the banking facility were very strict, that the first 10 million of equity had to come off the term loan, and anything other than that was going to be used against fees. So we wouldn't have actually benefited by taking any further equity. And that's why we restricted it to the 13 million. So we've taken this on the worst case SONIA rates. Actually, the rates have come down since we actually made that acquisition from SONIA. So and it's a ratchet scale. I think the current ratchet is a 2.43% above SONIA, and then every sort of 0.5 it drops down. Actually, it's a very similar facility to the one we had previously, just extended with a sort of bolt-on added on there as well. And that's the question I get asked a lot, and it's a really good question, because I think maybe some people have lost sight of how cash generative Strix had been in the past. Since we listed, we have raised, we've made 3 acquisitions effectively now. We put a factory in China, which was £20 million, and therefore our net debt has sort of held around that 1.6 times. with the exception of Billi, all of those other costs have now gone away. So we're back to the sort of normal model that we had, where we're sort of 85% cash to EBITDA ratio for the core business of Kettles. None of those terms have changed. So that's very important to us. And that's going to continue going forward. And Billi is around 88% cash generative. So again, it's very, very positive in terms of paying down that debt as we go forward. That's a really good question. It takes into account the dilution. Yeah, it came from our audit report from the end of last year. So they looked at our sort of assets and decided that the 30% of our assets have been completely written off, but they still had very, very strong useful life and were still in operation. This is everything from presses and so on that we have within the factory. And therefore, there was a report in there saying we should review all of the assets within the company. We actually chose not to do all of them. We looked at China and we looked at our own factory in Ronaldsway. We ignored Leica, because that's quite a new addition to the business, and obviously there was much more due diligence done on the assets at that period of time. But when we looked at all of the assets across China and Isle of Man, that's the adjustments we put into the accounts on the basis of that report from our auditors. Again, it's a question we get asked an awful lot. We have an exceptional relationship with the Chinese government, both locally and in Beijing. We've been instigating all sorts of patent cases in China for the last 2 decades, in fact, with very, very strong support from local government. Even the factory that we put there was on the land that we bought at 1/10 of the price of the land, based on our sort of position, being a PLC company and the relationships we had. So the honest answer is no. 93% of kettles today are still made in China. So even if we did have a problem, we could easily move our factory out of China. It's very much automated now, 77% automation. It's about 6 to 8 weeks to decommission and recommission a line. But actually, you still have to send all those controls back into China for 93% of the kettles being made today. So it would make no sense. That said, in other parts of the business, in water in particular, we have diversified. We've obviously got the factory in Italy now as part of the Leica acquisition. We are investing in additional production lines in Europe so that we can make product in Europe for Europe, and that will reduce a lot of the logistics costs going forward. And obviously, as we go out to the sort of future years, that will help margins as well. That's been a very challenging period for the market in China. The costs of farming have gone up almost exponentially. So there is very, very little money in that market segment today. The China government has recently started to put support in themselves, which is helping. But it has been quite slow in the first half of the year. And we also have our factory in Shanghai, which didn't help. So that really was the only part of the business that got caught up in sort of lockdowns during that period during the first half of the year. We are seeing some improvement in the second half of the year, so we're quite happy about that, although they tend to be the smaller systems because of the sort of lack of funding that's out there. But I think it's worth bearing in mind. So definitely we're still very much committed to that product, and we are still growing that product range in terms of the number of contracts that we have. It's worth bearing in mind that in our 5-year plan, we only had £10 million cumulative for that product range. So we still believe in that £10 million, albeit been quite slow over the last 12 months. I mean, end of last year, we saw the kettle margin come down, which I think was quite a shock to the marketplace, and then certainly had an impact in the conversations we had. That really was us, I think, being a little bit too late on the price increases in 2021. Obviously, we've corrected that. We put it back in 21, but we've also had another one in 22. So from a kettle point of view, I believe the margins are now very, very firm. If anything, we should see some upside to that with commodities starting to come down. We did have a massive impact of commodities during 2021. Obviously, as you move into 2021 going into 22, as we go into 23, and assuming those commodities continue to come down, that will give us quite a good buffer. And then I think as you continue to move forward and you start selling more filters rather than the fridge jugs and so on, those margins will stabilize and start to increase. So we are still, excluding Billi, we are still very, very confident of the 67 million profit we put out back in 2020. If anything, that was a conservative number.
No, it's not. It's not one of our own brands. It's a global brand. It's the market leader in North America for baby products, and so it's a collaboration with the brand using our technology on the market. On the water side, it's probably around 50-50. So we're very strong with private label partners. We can't list them all here for obvious reasons, but we have some very strong private label customers, some really big retailers and brands that use our technology. But our branded business on Leica has always been, the Leica brand has always been more on the branded side. But now with Aqua Optima, our growth in 2022 has been predominantly coming from the branded side. So we're really expanding and growing our branded business to give us a good mix between branded and private label.
Yeah, we look at the share price every day and are shocked by some of the numbers. And as I say, a yield of 8% today, we're starting to see some of our sort of original investors sort of come back in at that level who did very well out of the business, and certainly that's obviously positive. I think honestly the business is very secure. There's a couple of things that have come out when we've been going around roadshows to investors. One is the level of net debt. And I think in many times they've forgotten just how many things that we've done with the 3 acquisitions and the company. I mean, we started the journey at 1.7 times EBITDA when we listed. We got down to 0.7 at one point, our lowest point, paying down that debt, and then obviously we made the acquisitions, so it's gone back up to 1.6 times. That's something that we've had a lot of discussion of over the last few weeks and months over the roadshow. And I think when you see the deleveraging with the Billi, you see that only improves actually our capability of being able to drive that down. So that was certainly one area. I think the other area is we put out a capital markets day. I think a lot of people drew a straight line on that growth, really, which was not very realistic. It's not what we had in our plans. When you look at things like the appliance categories, they are devices that are selling for 200, 250 pounds. So obviously the revenue ramps up significantly as you get to the back end of that growth curve. And I don't think people necessarily have calculated in that way. They just put a straight line there, and therefore they were looking for confidence that we really could achieve that growth. I'd like to think as numbers start coming out now, you're starting to see that double-digit growth as we exit sort of the first half for appliances and water. Once that's delivered and sort of taken to the market, I think people will get back behind the numbers, and we'll start to see a shift again in a positive direction.